What if the financial advice you've been following your entire adult life, the stuff your parents taught you, your financial advisor repeated, the advice that sounds completely reasonable, is actually the thing holding you back? Not bad advice exactly, but advice that was designed for a different economy, a different tax environment, a different world. Advice that made sense in 1985 that is quietly costing you in 2025. Today we're going to challenge 5 pieces of conventional financial wisdom that most Americans follow without question, and replace each one with what the data actually supports. This might make you uncomfortable. That's kind of the point. Myth number 1. Always pay off your mortgage early. This one feels virtuous. Emotionally, owning your home free and clear is a beautiful idea. Mathematically, it's often suboptimal. Here's the reality. If your mortgage interest rate is 3.5%, or even 6.5%, and you're comparing that to the long-term historical return of a diversified equity portfolio of 9 to 10% annually, the math doesn't always support accelerated payoff. Every extra dollar you put towards your mortgage principal is essentially earning you a guaranteed return equal to your interest rate. But it's not necessarily the best use of excess capital, especially when that money could be working inside a tax-advantaged account. The nuance matters. Paying off high-interest debt aggressively makes sense. But treating your 3 to 4% mortgage like it's an emergency? That's an emotional decision dressed up as a financial one. Model the numbers for your specific situation before defaulting to the conventional wisdom. Myth number 2. Renting is throwing money away. This is probably the most persistent financial myth in America, and it has cost millions of people who bought at the wrong time, in the wrong market, with too much leverage. Here's what renting actually is. You're paying for shelter, flexibility, and the transfer of risk to a landlord. You're not paying for maintenance, property taxes, insurance, HOA fees, or the opportunity cost of a large down payment tied up in an illiquid asset. A 2024 analysis found that in over 40 of the 50 largest U.S. metros, renting and investing the difference still outperforms buying on a pure wealth-building basis over a 7-year period. Depending on what you do with the savings, buying a home is a great financial decision in the right market, at the right price, with the right mortgage structure, if you plan to stay for at least 5 to 7 years. But as a blanket rule, it's not automatically smarter than renting. Context is everything. Myth number 3. Diversification means owning lots of stocks. Most Americans think they're diversified because they own 30 different stocks, or even because they own a target date fund. But real diversification is far more dimensional than that. True portfolio diversification includes asset class diversification: stocks, bonds, real assets, commodities, private credit. It includes geographic diversification, domestic and international exposure. And critically, it includes time diversification, dollar cost averaging into positions over time rather than deploying lump sums at market peaks. The mistake: owning 50 different tech stocks or 5 different S&P 500 index funds that are 95% correlated to each other is not diversification. It's the illusion of diversification. The modern portfolio approach for 2025 and beyond incorporates alternative assets, real estate, infrastructure, private equity access through vehicles like interval funds, alongside traditional holdings. It's a more complex picture than your grandfather's 60-40 portfolio. Myth number 4. Max out your 401k every year, no questions asked. Hold on. Before you put down the pitchforks, maxing your 401k is generally excellent advice. But the nuance matters. First, always capture your employer match in full. That's a guaranteed 50 to 100% return on your contribution. Never leave that on the table. But beyond the match, the question becomes, what are your investment options inside the 401k, and what are the fees? Many 401k plans, much especially at smaller employers, have limited investment options and high expense ratios that meaningfully drag on long-term performance. For many high earners, a better sequence after capturing the match might be max your HSA, fund a backdoor Roth IRA, invest in a taxable brokerage with tax-efficient funds, and then return to your 401k. The flexibility and investment quality of outside accounts can sometimes outweigh the tax deferral benefit, especially if you're in the same or a higher bracket in retirement. The blanket rule isn't wrong, but the optimal sequence is personalized. Myth number 5. Your home is your best investment. Adjusted for inflation, the long-term average real return on residential real estate in the United States is approximately 1% per year. That's the research from Yale economist Robert Shiller, who literally won a Nobel Prize for studying this. The S&P 500 over the same periods? Roughly 7% real returns annually. Your home is shelter. It is an inflation hedge. It can be a powerful tool for building equity through leverage. But treating it as your primary investment vehicle, to the exclusion of market-based wealth building, is a strategy that the data does not support. The wealthy Americans who win aren't just homeowners. They're investors who also happen to own real estate. That's a crucial distinction. None of this means the conventional wisdom is useless. It means financial advice, like medicine, needs to be calibrated to your specific situation, your goals, and the economic environment you're actually living in. The most dangerous financial beliefs are the ones that feel obviously true, because they're the hardest to question. If this challenged your thinking, subscribe. We do this every week, and drop a comment. Which of these myths were you following? Let's talk about it below.